All right, Bernie, me and you, buddy.
Works.
Yeah, if there's any time you need to pause or anything, just let me know.
Okay.
I can pause the recording. We can have a offline conversation if you need.
Sure.
How are things in Boston?
In general, pretty good, really. We're having a good year for 2020. I'm still a little worried about 2021. We're pulling budget together kind of as we speak, and a little worried about top line revenue for 2021. Kind of hard to make money. I'm sure everybody's seeing it in this world that we're living in. Not even the COVID issue as much as it's the interest rate issue. And I know they're related. I know the interest rates are because of the pandemic, but interest rates are just so low that investment opportunities are virtually nil, and even lending opportunities. I mean, mortgage rates right now, 30-year fixed, going out sub 3%. It's just hard to make money.
Yeah, it's really hard to make money. I mean, I think that's a really common question we have in credit union land. I know in our credit union we do is that, it's hard to find investments that cover our margin. And long term, I don't see how we can kind of continue without at least being able to cover the margin. Certainly the safe investments have maybe aren't so safe anymore. Maybe they're slow death.
Yeah, I think it's a really difficult situation. If we were planning for 1 year of this, think about it, we've already been into it for more than 6 months. But if we were planning for 1 year of this and then somewhat of a return to normalcy, then I think we'd all get through it, even if we needed to dip into capital a little bit to make it work.
Mm-hmm.
When you hear the economists talk and you hear that it's 2023, and now I'm even hearing some people say 2024, before you even start to see any change in the interest rate environment. That means we're looking at this thing for the remainder of 2020, obviously, but then for 2 to 3 years beyond that. And I just don't know how many credit unions are really going to be able to survive this using their existing business model, because there's a second edge to this sword and it's hurting almost as much. Many of us are growing our deposits over fist. And we're growing our deposits at a time when we just don't really have any use for the money. We don't have any good place to put the money. As I mentioned earlier, investment yields are almost non-existent. Loan yields, personal loan yields are fine if you can get the money out the door, but it seems as if consumers are deleveraging more than leveraging. Mm-hmm. I know Boston Firefighters, our credit card portfolio is down almost $1 million year over year. So we're not making any additional money there. Our consumer loan portfolio is just about holding even. I'd be going month to month to tell you whether it was up a little, down a little, or where it is. But for conversation, it's holding even.
So how are you guys doing in new loans and that sort of stuff? Because I mean, the financial pressure is tremendous, because it's not just the environment, but everyone's being hyper competitive. The fintechs, it's just crazy. So you guys seeing any growth there at all?
Well, the only thing that's going out the door right now are mortgages.
Okay.
That's a total rate game. If we're willing to play in the environment, if we're willing to put 30-year fixed out at 3 or even just slightly under 3, then we can do those, and we can do quite a few of them. We've got a pretty robust pipeline right now. We were holding the line a little bit higher at rate, more like 3.25 or maybe even 3.5. And what we found that was doing, it was stifling our demand, and moreover, it was taking loans away from us, in that members were refinancing elsewhere because we just weren't playing in the rate world. So we're not playing aggressively in the rate world. Let me say we're playing at the high end of the competitive range in the world. And in that regard, we're doing okay. I just worry how much of that we can put on our books and sleep comfortably knowing that those are long-term assets at very low interest rates.
No, absolutely. And I think the thing we struggle with too is if people start going outside of our firefighter credit union world, we tend to lose a little bit of the tenaciousness of how much they love us and that sort of thing.
Oh, sure.
Yeah, and I think that's particularly prevalent with the younger generation than the older generation.
Well, there's no question with the younger generation, the loyalty factor isn't what it was with, let me say, their dads. I mean, in Boston, firefighting is kind of a family business.
Sure.
So we have quite a few sons and nephews and whatnot on the job now who, we knew their dads or their uncles really, really well. And their dads or uncles were fiercely loyal credit union people. They came to us for everything. We were top of the wallet. We were top of whatever else you wanted to call it. And despite the fact we service the accounts the same way and we think we do a good job, we don't win as often with these young firefighters as we did with their dads.
Sure.
These kids they're moving for 25 basis points.
Yeah. When were you guys established, Bernie?
Oh God, over 70 years ago, Mike.
Okay. Yeah, it's amazing how the firefighter world has really changed in that time. I know that, all fire departments, I think, have that family thing going on. Certainly on the East Coast, I think it's even stronger than on the West Coast, but
Sure.
on the West Coast too. So what are you guys doing with auto loans? Doing anything there? I mean,
getting auto loans at the time of the purchase of the automobile has always been an issue for us. We've never really competed well with dealer financing.
mm-hmm.
And we've never really tried. We never really established any kind of an indirect business because given where our field of membership is and they're kind of all over the place geographically, there wasn't really any effective market presence that we could build to do an indirect program. So we never really did that. And we just found it increasingly difficult to compete with the dealers for point of purchase type auto loans. So what we did, we actually stole a marketing campaign from one of the really large credit unions in our neck of the woods. They call it their second chance auto loan. They advertise on TV and radio and all over the place. So we've kind of piggybacked on that. And what we do is 2 different times a year, usually once in the spring, once in the fall, we do this promotion whereby we offer 1% cash back for any member who refinances their auto loan with us.
Okay.
You come in with the $30,000 car loan, you get $300 credited back to your share account.
Oh, okay.
And, we do it at whatever our rate is. I think right now we're going out at our best rate. We do risk-based pricing, but I think our best price right now on an auto is $199. So you're getting $199 as a rate. Obviously, if you qualify for that, you're getting the 1% cash back. From a credit union accounting point of view, we expense the 1% in the first year of the loan. So it means that our yield, instead of being $199, that first year is $0.99.
Mm-hmm.
And the yield jumps back up to $199 for the rest of the loan. So when you're in a low rate environment like this, you're putting the asset out at 0.99, which still beats the shit out of what you can do in investment products. So we're happy to do that. And then we get a 1% kicker on the first anniversary.
Yeah, that's not bad at all. I assume you're only getting people signing up if the interest rate they're currently paying is slightly higher than what you're offering.
It's funny. Yeah, you would think that, but that's not always the case.
Oh.
A lot of our members still like the idea of paying weekly payroll deduct.
Yeah.
And, so to speak, the money's gone before they see it. And that's a feature that we still talk about quite often.
Mm-hmm.
A lot of them, even if the rate's borderline, they'll come in and they'll do the loan with us. The only reason we don't get the loan right up front is the whole convenience issue. You're buying the car, you're at the dealership. First of all, they don't want to let you out of the dealer, without signing the paper.
Sure, I know, yeah.
It's
just a property line, won't they?
right, just about, yeah.
Yeah. I've talked to a couple of credit unions. They've had some success with these auto buying programs where you never go to the dealer, you negotiate everything up front, and the car's delivered to your house, to your work, to wherever you want to do it. The credit union does the financing, and we've had a little bit of success with those sort of things. Because people hate going to the dealer.
I'm familiar with them. We have never tried one. We've talked to a couple of the different vendors that are out there that offer those programs. We've talked to certain members. We've certainly talked to our board members about it. We didn't think that there was a lot of appetite for it, so to speak. But, I think in a world that's becoming increasingly more remote, look at the way we're doing this interview, Mike. I mean, a year ago, we did this interview on a stage and we were face to face, and,
Yep.
we thought that there was value in that. Now, we're doing it on Zoom, and we're doing everything else we do on Zoom. And so I think this idea of purchasing a vehicle without going to the dealer is probably going to gain some pretty significant momentum going forward, just like a lot of other things in the world that are going to change.
Yeah, look at how much Amazon's changed our idea of shopping. Why go to the store when you can have it dropped off at your door,
Yeah.
Beautiful. So it kind of leverages us to the pandemic. And so how's the pandemic changed how you guys operate and how your credit union's kind of business model structured?
Yeah, in the short term, it's changed it pretty significantly. So back, I forget the exact day, but since it's a big day in Boston, it was right around St. Patrick's Day. Governor made a decision to close down the state. And with the exception of our drive up, we were closed. So we kept our drive up open as a way of servicing some of our members. We did the rest of it remotely. We had a very small number of people coming into the credit union on a daily basis. We learned how to work remotely really quickly. Prior to the pandemic, I would say that we have a total of about 40 staff members. I would say we probably had about a dozen people who had remote capability prior to the pandemic. They were all part of our management team. We all had laptops. We all had VPN connectivity. So we were all set. But the vast majority of our staff, our loan officers, our member service representatives, people like that, did not have credit union issued equipment and really didn't have the ability to work from home. So we scrambled, and in about 2 weeks, and we were doing it at a really tough time to acquire it because everybody else was trying to acquire it too. But in about 2 weeks, we acquired enough equipment to get, I think we're up to about 32 or 33 people who work from home capability. End of May, maybe around Memorial Day, we opened back up. We opened our lobbies back up. We try to practice social distancing in the lobbies. What we've noticed is that the members really haven't come back in the numbers that they came into the branch prior to the pandemic. So whether it's people don't want to be in a public place, or whether it's people's habits have changed a little bit and they're doing things on the phone or they're doing things through various electronic channels, we don't have the lobby traffic, even though we're wide open and available for people. But we still have a lot of people working from home. All of our call center people are working from home.
Mm-hmm.
And as far as our management and our back office people, I would say it's a split shift type of thing.
Yep.
Practice social distancing. We're asking people to stay at home at least a couple of days a week. We know that there are people, I'm one of them, I much rather would be working in the office. I think I'm more effective working in the office. But every week that goes by and I get better at this and I do more of it, I become more comfortable with it. You can probably tell from the backdrop, I'm working from home today.
Yeah.
And, I'm getting used to it. A lot of our team members are getting used to it. And I think to some degree, it's going to be our future. I'm not quite in the camp that says nobody is going to go back to work once this thing's behind us. I don't think that's true. I actually think that pendulum has started to swing a little bit back toward some people being in the office some of the time. And I think, managing people working from a remote backgrounds is a little bit of a new skill set.
True that.
You're not managing the people right under your nose. You're not going into the call center and seeing what's going on, and you're learning how to do things a little bit differently. So I think those are all the challenges we're playing with right now.
Yeah, it's interesting. I would say there's still nothing that replaces face-to-face in those hallway conversations and stuff, whether it's at the office or a conference and that sort of thing, that are kind of an essential part about, a lot of the tactical and strategic decisions we end up making, sort of thing. That being said, I also think that that doesn't mean we have to be there every day. And I think we've proven that. Yeah.
Well, I think that's what I mean by the pendulum is swinging a little bit.
Yep.
People who in April and May were saying that they'd never be back in the office. They would never rent back office space again. Everybody will work from home 100%. And I think that's backed off a little bit. I think that you're now seeing people say, well, we're going to have a back office presence. We're going to have people coming in at least some of the time. And I think it needs to be worked out. Does some of the time mean 40% at home? Does some of the time mean 60% at home? And I think that's going to vary by the place and also vary by the job function.
Sure, absolutely. Yeah. So have you had any staff members that have tested positive for COVID?
So far, only one, and it was a part-time teller who only worked Saturday mornings.
Okay.
And so it had minimal disrupt as far as the credit union was concerned. We asked all of the people who had worked that Saturday, which was only 4 other people, but we did ask all of them to get tested before they returned to work. They all tested negative. I think they might have missed one day and gotten back pretty much right after that. So, so far so good in that regard. We've been lucky.
Oh, good. Have you had anybody any member come in and kind of not be non-compliant with the social distancing and masking? And
we really haven't, Mike. The members have been great in terms of
Right.
Early on, we were being really strict. The first week that we opened up the branches, we were opening them up and we basically had a guard, one of our own employees, but we basically had a guard at the door, and we were letting people in like 2 or 3 at a time in order to keep social distancing intact. And we were obviously at that point making sure that the member had a mask on. And then, what we realized is what I said earlier, that we don't have this overpowering demand for branch services right now. Yep. So we kind of found that guard wasn't really necessary. We went back to opening the doors, but we still require every member who comes in to be wearing a mask. And, we've had no issue with that. Most of our members are either first responders or their families of first responders. They understand probably better than the general public.
Yeah.
On.
Sure, they're used to being in PPE, aren't they?
Yeah, and they're going out on calls and they're seeing people who are sick. And, I think they realize that the virus is real.
Yeah.
Yeah,
absolutely.
They're seeing some of the worst situations of it, obviously, when they get a 911 call, and have to go out to a house where somebody needs to have oxygen immediately and is being rushed to a hospital and potentially going into an ICU. And I think the fact that they see that gives them a little bit more, I guess we'll use the word appreciation for what we're dealing with.
Sure. Yeah. And part of my time, I was on a specialized rescue unit in San Diego. We went to all the traffic accidents that became complicated. And boy, man, seeing all that, man, changed my driving, man. I became a much safer driver. I didn't want to be in one of those accidents, man. Those were really brutal.
So Mike slowed from 95 down to 85 on
Well, sometimes if you're not going 85, you'll get run over. So, any physical changes you made to your branches? You have 2 or 3?
We have 2.
And drive-ups or walk-ups adding, or do they both have drive-ups?
No, we only have a drive-up at 1. So when the pandemic hit, we closed the smaller of the branches. There was nothing we could do there. There was no drive-up, and there was really no effective way of servicing people with keeping the lobby closed. So we left that closed and pointed everybody back to our Dorchester location. Worked the drive up. Working the drive up was a challenge. We had days where the line for the drive up was pretty significant.
Really?
Fortunately, by that time, the weather was getting better. And we actually had staff members who were going out with masks on, of course, and going up to cars that were in line at the drive up and trying to help them before they got to the window.
Oh, great.
Handing out forms that maybe needed to be filled out, or depending upon what the members' needs were, taking the members' materials from them, asking them to drive around and park in the parking lot, and would process the transaction and bring it back out to them. So we had a pretty good model going on with that. And that lasted the better part of 2 months. I would say over those 2 months, there were probably only there might have been 10 days that we had that kind of a line. Fridays tend to be busy, and the day that our retirees get their pension checks tends to be a real busy day. And being in that demographic, those people still really like to come in. A lot of those people still like to get green paper with pictures of dead presidents on it, and work from a purely cash world. So we know what our demand is. We kind of know what the busy days are going to be, and we kind of met it head on.
Okay.
So in terms of physical changes, just back to that, the only thing we did was the plexiglass shields.
Sure. Okay.
I think just about everybody did those.
Yeah. Everybody in every place.
Put them in the teller line, put them on the member service desks, put them on the loan officer desks. Just, we still ask our employees to be masked. We still ask our members to be masked, but I don't know. I think everybody feels a little bit more comfortable with that piece of plexiglass separating.
Yeah, well, I think it's kind of like wearing a face shield and a mask at the same time, and provides, a little bit less transmission. It seems to be fairly clear these days that the airborne virus is the primary means of transmitting this thing. And so
yeah, I agree with that as well.
So we talked about investments a little bit. So and you said there's really kind of nothing in the traditional space. Are you looking in any non-traditional spaces or alternative investments, as we like to call them in the credit union world?
Yeah. So, we will look at anything and we will think about anything. So probably a couple of years ago, we really started thinking about participation loans, an alternative to investments. And we have about 10 million of participations on our books right now. We've kind of taken a step backwards on participations since this thing has broken. Most of the participations that we were doing were in the commercial real estate space.
Sure.
And a year ago, that, at least in my opinion, was a really good diversity investment for us, because we don't have a commercial real estate portfolio of our own. The characteristics, the risk characteristics, the interest rate characteristics, just about everything is a little different on a commercial real estate loan than it is on a residential real estate loan. So by us being able to do that, we were able to get some pretty good yield. And at the same time, we were able to diversify our portfolio.
Sure.
But when the pandemic hit, the outlook for commercial real estate going forward is, I'm going to say, cloudy at best. You think about the two major areas of commercial real estate, office space being one of them, and we already talked about that, but then retail space. What is the retail space world going to look like when all of these existing leases dry up?
Sure.
So much business, and not just the Amazon business, but so much business is being done online, whether people are doing Amazon, whether people are doing Walmart, or whether people are dealing with the shops that they used to go to, but instead of going to the store, they're going to the website.
Yep.
And I don't know. I just see an awful lot of vacant commercial real estate in our future. And so we're going to stay away from that asset class, at least for a while. One of the concerns I have, and I've had some discussions with some NCUA folks about this, because depending upon how NCUA plays the pandemic, they could be pushing credit unions to, I think, make some not great decisions. And what I mean by that is, if NCUA doesn't adopt a very understanding overtone about things like ROA and even things like capital ratio as we go through the next couple of years, then you're going to have credit unions that are going to be reaching for yield. And every time we as an industry reach for yield, something bad happens.
Yeah.
We get out of our comfort zone. We start to get into things that we don't necessarily understand. And so, the words of advice that I would give would be, try to stay conservative if you can. If you can't, and you really need to start looking outside of your comfort zone, do your homework. Understand what it is that you're buying. Understand what it is that you're investing in. maybe get some third-party help if you don't fully understand it. I know, we've gotten into some investment things and, more recently because of our mortgage lending, we've started to get involved with some derivatives as a hedge against interest rate risk. But we don't do any of that just on our own. We have a third party that we work with that helps us immensely in that regard. And, quite honestly, Mike, we pay a price for that.
Sure.
I think it's a price that's well worth what we get.
Yeah. And to kind of piggyback a little bit on what you were saying with the regulatory environment, because I know many credit unions, like my credit union, are growing their assets tremendously. The investment opportunities really aren't there. And so you have basically cash that's earning nothing. And our investments, as they reprice, are coming down. So our ROA is suffering. And when you get assets and ROA both suffering, it magnifies the impact on capital. So I think we're going to see a lot more credit unions get under the 7% well-capitalized thing at a time when, what do you do? And so I think you're right on there. That's going to be a very challenging time. It's going to put pressure on credit unions.
Well, and it's not just credit unions, it's community banks, it's everybody who exists in the same space. I mean, we're in a space where net interest margins just aren't there. If you think about it, Mike, the typical credit union in our membership, ours being the firefighter group, probably operates for something north of 3%.
Sure.
The operating expense ratio, you're probably looking at, I don't know, I don't have the number. I'm sure Grant does, but he dropped off the call. It's probably like 3.25. And let's just say it is 3.25. Just humor me with that. So I'm out today making mortgages at 2.875.
Yeah.
So the interest rate on the mortgage doesn't cover my operating expenses.
Yep.
Never mind, doesn't pay a cost of funds. Now the cost of funds is minuscule.
Yeah.
Because none of us are paying anything for these deposits. So, maybe you're getting away with an overall cost of funds of something around 40 or 50 basis points. But if you're 50 basis points on cost of funds and you're 3.25 on operating expenses, then you basically need 375 to break even.
Yep.
Finding 375 today is not easy.
Well, particularly if you don't want to take on some ungodly amount of risk.
Right.
Yeah,
Right.
I know.
So, I don't know what's going to happen in that regard, because if we keep bringing in the deposits the way we're bringing them in, we're fortunate. I mean, we've dropped almost 100 basis points in our capital ratio, but we've dropped from 12.5 down to 11.5.
Yeah.
And that's all been because of growth. Our growth has been explosive. We're probably going to do 80 basis points of ROA this year.
Yeah.
So it's not like our ROA is terrible. I mean, 80 basis points isn't that bad.
Especially in this environment. It's great, actually.
So we'll take that, but our growth of deposits has been such that we just keep watching our capital ratio go down, even though we're making money every month.
Yeah.
Look, that's one of the conversations I've been having, kind of behind scenes with some friends in high places at NCUA, is just trying to get them to understand that they're going to have to take a long, hard look at this. I mean, they've got to take a look at their own shop, because as much as we're dealing with what we're dealing with, they're potentially dealing with a similar situation with the insurance fund.
Oh, yeah. Because
the insurance fund, is supposed to keep a 1.3% balance. But as you increase the denominator is insured shares.
Mm-hmm.
As you increase the denominator, and it's increasing as all of us bring in these deposits, that goes right to the bottom line of that denominator.
Mm-hmm.
And their numerator is, basically what they can earn on investments. And they're investing in the same investment world that we're in. They're actually investing in even a narrower world, because they're primarily buying treasury obligations.
Mm-hmm.
So you get a world where I think today a 10-year treasury is getting you a little over 80 basis points.
Mm.
So they've got a problem in that they can't make any money off their fund.
Yep.
The shares they're insuring are growing leaps and bounds, and their 1.3 is going to come under pressure. And it's at a really bad time, because they can turn around at some point and say, okay, credit unions pay a premium.
Yep.
That's going to be insult to injury in the credit union space if that happens, because all of us are going to be hurting, And now on top of hurting through our normal operations, we're going to potentially at some point be looking at an NCUA premium.
Yeah, that'll be fun, won't it?
It'll be a great time.
So, switching topics a little bit, cybersecurity, data, transaction security. Any new thoughts or issues in that realm?
I'll tell you, we spend a fortune on trying to safeguard.
Yep.
You know, between preventative controls and detection type controls, we spend a lot of money trying to safeguard our members' data. And you know, we've been very lucky that we've not had anything happen to our members' data. We've not suffered any kind of a breach. We've not had any kind of a difficulty in that regard. But, you know, you look at the world, and I wish I could quote the number. We had a speaker speak to our board, it might be 3 years ago, and he told us what JP Morgan Chase spent in a year on cybersecurity. I remember it was more than the total asset size of my credit union.
Oh, wow.
And they got hacked.
Oh.
A buddy of mine runs a credit union in a very big, well-known company. I'll leave the name out of the company for obvious reasons, but the credit union uses some of the company's computer infrastructure.
Ooh.
If I told you who the company was, you would say, well, that's probably a pretty good idea because they must have people and they must know what they're doing and everything must be great. They got hacked. They got hacked for ransomware. Didn't pay the ransom. The credit union was without access to the data that was on the company's servers for 2 weeks.
Wow.
Yeah.
Wow. Yeah, I think clearly, sorry for the phone here.
Does that mean we're done?
No, I hope my wife's going to get it, but.
That's actually Grant calling and telling you to stop talking or telling me to stop talking.
Yeah. Anyway, so what are you worried about other than what we've already talked about?
Yeah, I think the biggest thing I'm worried about, we've already talked about, is the interest rate world that we're living in. It's from a bigger perspective, can the credit union business model that we've all been running with for a long time survive?
Yeah.
This is going to be a multi-year rate environment. Can we continue to make enough money off spread, which is what most of us do, in order to survive? Or are we going to have to do something else? And if we have to do something else, it's almost going to be fee income. You know, I can see a scenario where the days of free checking are behind us. You know, because if you stop to think about it, when we call it free checking, it isn't free. There are expenses associated with it. We're just absorbing those expenses and we're making money off of our members someplace else.
Sure.
Be it loans, be it whatever. We're making money someplace else. But as those someplace else's dry up and we can't make money there anymore, and we're under pressure to have some kind of a bottom line, how long before we start to look at, and I don't even call it the checking account anymore because young people don't write checks, let's just call it a transaction account. How long before you have to start charging members for the transactions that you're processing on their behalf?
Yeah.
Think about all the things that we facilitate for members and members take for granted. We offer a debit card, we offer home banking, we offer bill pay, we offer all of these things, and most of us do it for nothing.
Yep.
Do it just to be a good business partner with our members. But if we can't make money in the other places, then I think there's some change to our business model coming down the road, and I don't think it's going to be far down the road. I guess that's the bad news. The good news is that we're not going to be alone. The good news is, as I said before, the community banks are going to be fighting the same fight. So they're going to be doing the same thing. I don't know where the commercial banks, the big guys, I don't know where they'll be in that regard. I get a little worried that if they have other ways of making money because of the assets that they're playing in and the businesses that they're playing in, I get a little worried that they might be able to blow us out of the water. In Boston, Chase is making a major push.
Oh.
First time they've ever tried to come into Boston, they're coming in with 30 plus branches.
Oh, wow.
They're going to try to chase retail banking. And, if they can do it and they can undercut us on pricing, add that to what I said earlier about the younger members and how the younger members will leave for a better value or what they perceive to be a better value. I get a little bit afraid of that.
Yeah.
I used to always say, Mike, that the big guys weren't our competition. But I don't know if you've ever heard Mark Seavright speak.
No.
Mark's pretty active in the credit union space. Mark's a friend of mine, been involved in credit unions for a long time. And Mark had statistics that in 2018, I know these are a little dated right now, but they're not ridiculously dated. 53% of the new banking accounts in the United States were open at either Chase, Wells Fargo, or
Citi, maybe?
no, Bank of America.
Oh, B of A. Yeah. Okay.
One of those three combined to open 53% of the new accounts in the country in 2018.
Wow. And
And
probably
also-
for assets under management, they got to be up in the 60-70% range, I would imagine.
And, then you add to that I think it was also 2018 was the first time that we didn't beat them, we being credit unions, didn't beat them on customer satisfaction.
Really?
They actually beat us in 2018 on customer satisfaction. And if you drill down and you find out why they beat us on customer satisfaction, it was the electronic products and services.
Oh.
It was the frictionless, the key word that's out there these days, but it was the frictionless environment that they were creating with their electronic products and services.
Yeah. And to do that, that's definitely economies of scale and big numbers to get all that stuff
Sure,
right.
sure.
Yeah. They can afford to do it.
They don't even, for us to provide technology, we have to partner.
Yeah.
We have to go out and find a vendor, or we have to band together and find a vendor or something of that nature. None of us have the ability to hire a team of people and create a product from scratch. But, your B of A, your Wells Fargo, your Chase, you can do that.
No.
You can hire a team of fintech savvy individuals and tell them this is what you want.
Or just go out and buy the best third-party vendor out there.
Well, that's another.
I mean,
Yeah.
proven production. Oh,
Yeah.
wow. Well, I'd like to finish with, do you see any opportunities out there for credit unions after this challenging time?
We had this discussion, we had a planning session a couple of weeks ago with my board, and the exact question came up. Is there an opportunity, or otherwise, is there light at the end of the tunnel? I always like to be optimistic, and I like to think that there is. And I like to think that the way we service our members and the way we really take pride in doing the right thing by our members, I really do think that that will keep us in a good place. I do think, though, that we have to weather the storm for a couple of years. And I think those of us that have the capability to weather the storm need to be sure that we don't stop spending money, that we don't stop looking for ways to make ourselves better, because if and when this thing ends, those that emerge with the better product mix, those that emerge with the better technology mix, those that emerge with the better customer experience, member experience, are going to be the ones that carry the day. So I think if we can combine what we've been good at forever, which is the member service and the caring environment and the giving back to our community, I think if we can combine that with a really good member experience and a really good technology-based product mix, we'll be okay.
Okay. Well, Bernie, I really appreciate your time. It's insightful as always to talk to you. And I also want to thank you for the support Boston and you personally have shown for the National Council of Firefighter Credit Unions throughout our history. Thank you very much for that.
Happy to do it, Mike. I always enjoy sitting down and talking business with you.
Yeah, likewise, my friend.
The only thing that's missing is that beer.
I know exactly. My thoughts exactly. Well, hopefully next year in Fort Worth that we can fix that.
Absolutely. Looking forward to it, Mike.
All right, take care, Bernie. Thanks a lot.
You as well. Bye.
All right, bye-bye. So, stop recording.